You're prepared for the new inherited IRA rules that take effect this year? If you're not, could cost you 25% in a penalty. I'll explain those rules, that and more coming up. My name is Mike Bernard. I'm the host of the Wise Money Show. I'm also one of the certified financial planners right here at Korhorn Financial Group. Make sure you hit that subscribe button, turn on notifications, and smash that thumbs up. That's right. We've warned you. We've shared the new rules and just all the drama surrounding this. There's been a lot, but it's worth the reminder. And I saw a headline recently that was just flashing the warning sign again. Listen, if you're not aware of this, if you miss this, could cost you 25%. That's right. That's not 25% tax. That is a 25% penalty plus the tax. What we're talking about is the new inherited IRA rules, and here's how it works, guys. Starting on 1/1 of 2020, this has to do with the Secure Act 2.0, or excuse me, Secure Act 1.0, 1/1 of 2020, if you inherited an IRA, a pre-tax retirement account. I had a question recently on a video we did about this topic, and they said, does this apply to pre-tax 401ks as well? Yes, it does. Yes, it does. If you inherit an IRA or pre-tax 401k from someone that died on or after 1/1 of 2020, there's new rules. It's no longer the old rules. The old rules allowed you to just calculate a required minimum distribution based on your own life expectancy, not the original IRA owners. And you could withdraw as much as you want, but you had to at least withdraw that minimum, that required minimum amount each and every year, and there was no deadline. You could just, draw that out every single year and stretch that account out over your lifetime. Those are the old rules. That went away starting 1/1 of 2020 and replaced by the 10-year rule, which means you've got to empty that account. You've got to empty that account by the end of the 10th year after they pass away. What's been unclear, or what was unclear, was, well, do you also need to take an annual required distribution as well? And originally, no one expected that to be the case. No one, that really wasn't the precedent. And then a couple of years after the new law took effect, the IRS published or released a publication, and there was an example that showed, you've got to take this annual required distribution as well as having the account emptied within 10 years. There's this back and forth. You're kidding me. Yeah, no, maybe so. And that's the new rule, and it takes effect this year, starting in 2025. So here's a real life planning example situation I was just dealing with. Individual that we are serving, we were serving mom and dad. Dad passed away, and mom continued to live for another 6-7 years, and then a few years ago, mom passed away. And when that occurred, it was in 2022, so we knew that, okay, the new rule, the 10-year rule applies. This is after the publication came out, and so we were up front that, listen, you might need to take a required distribution. We don't know yet, but we do know for sure the account needs to be emptied by the end of that 10th year, so 2032. And so we talked about the different planning implications, and listen, you're not required to take a minimum distribution right now. We're watching these rules. And for the first few years, she was like, nah, I don't want to take one. I don't want to take one. Well, now, starting in 2025, there's no longer a choice. We have to calculate a required minimum distribution for her based on her life expectancy, okay? And that amount is, call it 10 grand a year, that she's required to take out. However, the amount that she would need to take out in order to have the account emptied within 10 years would be somewhere around $25,000 a year. So note that this minimum amount isn't enough to get the account emptied within 10 years. You've got to do both. You've got to do a combination of both. But here's the thing. If she wasn't aware that this new requirement started this year and she didn't withdraw the 10 grand, the penalty on that would be 25%. It used to be 50%, by the way, guys. They reduced it to 25%. So if she failed to withdraw that 10 grand, that's a $2,500 penalty. On top of the tax, which in the 22% tax bracket with 5% state would be another $2,700. So of the 10 grand, she'd only be left with less than 5 grand, right? After the tax and the penalty. So you don't want to miss this. You need to be aware that this rule starts in 2025 to take a required minimum distribution from those inherited IRAs or pre-tax accounts from someone that passed away 1/1/2020 or thereafter. Are there exceptions to that? Yes, there are. Just did a video about eligible designated beneficiaries. A spouse, surviving spouse, is eligible to continue to stretch it out over their lifetime. They also are allowed to just take that IRA and make it their own as well. And so there's some choices there. There's a handful of other eligible designated beneficiaries that are still allowed to stretch the IRA under the old rules. So check out that video there as well. But either way, anytime you're inheriting a retirement account or receiving an inheritance from someone, you've got tax planning, you've got financial planning. There's a lot of considerations that you need to plan through. So work with your certified financial planner on that, but at the very least, make sure that you're taking this required minimum distribution starting this year, assuming the individual that passed away was already past their required beginning date. That's one important detail I hadn't mentioned yet. So work with your certified financial planner on that. If you don't have a CFP on your team, you can contact one on my team. Find us online, Korhorn.com. That's Korhorn with a K. WiseMoneyShow.com. You can find us there as well, or give us a call, 574-247-5898. All right, there you have it. Go out and take your next wise step in your financial life.